welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 13th of February 2024 and here are the questions we will be answering today. Why is India's FDI taking a hit? Does UPI backend need a relook? What did the Q3 results season mean for the street? And what is the Strategic Petroleum Reserve? The Indian economy is expected to grow at 7.3% in the current financial year, RBI's rate setting panel said this last week. If realized, it would be the third straight year that India will grow at 7% or above. With such impressive growth, India should ideally be the favored destination for foreign direct investment, especially at a time when the West is trying to find an alternative to China. But the net FDI inflow into India has been declining. It fell by 31% in April-November 2023. But why? Shivam Tyagi and Ayush Mishra look for answers.
In its latest State of the Economy report, the Reserve Bank of India has said that the net foreign direct investment between the period April to November 2023 stood at $13.5 billion. It was 31% down when compared to the same period of the previous year, when it was $19.7 billion. Net FDI is FDI inflow minus FDI outflow, which includes repatriation and disinvestment. According to the RBI report, net FDI has been on a decline for some time. In FY23, net FDI into India fell by 26% to $28 billion from $38 billion in FY22, while in FY21, it was $44 billion. So why is India's FDI seeing a declining trend?
Channels for FDI flows and the sectors into which they were flowing, construction, pharma, light engineering, auto components, etc., that seems to have reached a kind of a saturation point. So in these industries, FDI flows have come down to a thin trickle. Having said that, FDI flows in the services sector, which accounted for a bulk of the flows, that has not been really impeded very much. But there are a few issues regarding that as well. One of them is that the technological startups, which were there in the past few years in large numbers, that flow also seems to have come down a bit. So companies which came up with new technologies and wanted to go global and raise funds from abroad, and which led to FDI flows, that has also come down quite a bit.
I think it's falling really because if you look at where our FDIs come from in the past, it's come from a few large ticket service investments. So I would actually recommend looking at the last, say, 5 years of FDI and looking at what makes up the bulk of that FDI. So, for example, in a single year, we had the Walmart investment in Flipkart. And that accounted, I think, for almost half of our FDI in that year, just that single investment. So you have some of these chunky investments that take place that account for a disproportionate quantum of FDI. Where we have, I think, always lacked in FDI is in FDI for normal run-of-the-mill manufacturing plants, especially manufacturing plants that are aimed at export. That's where China excelled for decades. And we're starting to see other countries, the China plus one countries, excelling also in that area, but not yet us.
During April to November 2023, sectors such as manufacturing, electricity, transport, financial services, retail and wholesale trade contributed around 2/3 of the gross inward FDI equity flows. 70% of the equity inflows were received from Mauritius, Singapore, Japan, the US and the Netherlands in FY24. According to reports, one of the factors contributing to this trend could be the termination of the bilateral investment treaties or BITs. These treaties offered companies legal benefits in court cases or arbitrations that took place in a third country, ensuring impartiality. Till 2015, India had BITs with 74 countries, but over the last few years, the government has scrapped 68 of them. Today, only 6 BITs remain in force, according to government disclosures in the Upper House of Parliament in 2023. A study published in the journal The Review of International Organizations in 2022 observed reduction in FDI inflows to India by 30% in response to BIT terminations compared to countries without such terminations. So, are fewer BITs a reason for falling FDI in India?
Without question, scrapping of bilateral investment treaties damages foreign investment flows. Because people want the security of being able to go to arbitration if they so choose. We've put together now a model investment treaty. I think it's still lacking. I don't think foreign firms and foreign countries find it attractive, and it's something that we need to see as a necessary part of what we must do to be able to trade effectively with the world and to attract a lot more investment.
On top of that, some experts also believe that India's trade policy needs some rejigging while negotiating the free trade agreements or FTAs to attract FDI.
I think, other countries have used FTAs as a way of making themselves more attractive for FDI. We have not. So, for example, if you talk to Singapore, they will tell you they are part of all these free trade agreements. So that's why they're an attractive place for companies to locate their headquarters or whatever. Vietnam, same thing, right? They have all these trade agreements with different countries, different parts of the world. Again, they say so that you have duty-free access then from Vietnam to all those countries. That's not been part of our trade policy mindset. And I think it's a good shift if we want to be serious players in export-oriented manufacturing.
In contrast, countries such as Vietnam, Indonesia, and Thailand have recorded high inflow of foreign capital. Vietnam saw a 32% increase in its FDI inflows in 2023. Indonesia also witnessed a 13% increase, while applications to invest in Thailand climbed 43% to a 5-year high in 2023. So, is that a setback for India's aspirations to become an alternative investment destination to China, which has been an engine of world growth for over 2 decades?
If you compare the Southeast Asian economies like Thailand, Indonesia, and Vietnam, in the case of Vietnam, they have provided a very good platform for foreign investments to flow in. And in terms of facilitation, in terms of access to the ports, airports, etc., it is far ahead, if I may say so, than India in terms of the logistics infrastructure and the time taken to export. Because Vietnam by itself does not provide a very large domestic market. So most of the foreign investments which are coming into Vietnam are for exports. Similarly, in the case of Thailand also, to my knowledge, the logistics infrastructure has already been put in place and it is more efficient than that of India.
Experts agree that global slowdown has indeed affected India more than its competitors such as Vietnam, Indonesia, or Thailand. To attract more foreign capital, India needs to have better policies and less regulations. It should also become regionally competitive and export-driven rather than consumption-driven.
On its part, the government is trying hard to attract investment. Its PLI scheme has attracted investment worth 1 lakh crore rupees till November 2023. And this week, Israel's chipmaker Tower Semiconductor has submitted a proposal to set up a chip fabrication plant worth around $8 billion. Moving on, the country is set to become the fastest growing digital economy in the world. However, there are challenges too, like the one which we saw last week when UPI payments were affected. So, does the UPI backend need a relook? Kasturi Akhil finds out.
Did you face problems in making payments through Google Pay, PhonePe, Beam, and Paytm last week? Well, you were not alone. Users from across the country reported payment failures on 6th of February. And there was a common thread in all the glitches. That was the real-time payments system, UPI. Several banks, including HDFC Bank, Kotak Mahindra Bank, and State Bank of India, reported facing problems while making UPI payments. The outage lasted for about 3 to 4 hours, prompting netizens to express disappointment on social media platforms. According to Down Detector, a website that tracks service issues, the UPI outage peaked around 8 p.m., with about 132 outage reports of users logged on the website. But who runs the UPI? It is being run by the National Payments Corporation of India, or NPCI. It is a not-for-profit organization established by the Reserve Bank of India and the Indian Banks Association that facilitates services like UPI payment, Bharat Bill Pay, RuPay Card, FASTag, etc. The glitches prompted NPCI to issue a clarification on the social media platform X. It said there that the NPCI systems were working fine and that the users were facing UPI connectivity failures due to internal technical issues with a few banks. But India's largest private sector lender, HDFC Bank, said the difficulties on UPI seem to be part of a larger ecosystem.
I don't see these errors in the UPI system more of a regulatory or a policy issue. If you look at the last 5 to 7 years in India, it's more of an infrastructure issue. Because in terms of transaction failures and technical glitches, it's not just the banking system and UPI that's been having failures. Even if you look at the ROC website, or even if you look at the other government digital infrastructure, like even something as the income tax department website. I mean, if you look at the trend that has been there have been, whenever there's any pressure put up on the system, these systems have collapsed.
This isn't the first time UPI has experienced glitches causing countrywide payment disruptions. Notably, NPCI data showed that unscheduled downtime for UPI service cumulatively lasted for more than 3 hours in 2023. The number was lower than 2022's 5-hour downtime, yet it was above 2021 when the service was down for over an hour in total. Unscheduled downtime due to instances like server failure are not the only challenge. The problem of transaction failures due to other reasons also exists. Last year, a consumer court in Kullu, Himachal Pradesh, directed Bhim app to pay 20,000 rupees with 6% interest to a UPI user who had filed a complaint against Bhim app and SBI Solan branch seeking redressal for a failed transaction and alleging deficiency in service. So what can be done to fix the problem?
From a policy point of view, there may be a time for some relook, maybe putting out some norms of minimum investment into digital infrastructure. Maybe, I mean, this is something which will probably require collaboration between policy experts and technical experts. But some minimum investment norms in the digital infrastructure would have to be brought out. There are some suggested by the RBI, but definitely I think it would need to be a bit more comprehensive.
We don't know whether this problem is at the bank's end or it is at NPCI's end. And everyone can blame someone else, but there needs to be transparency and accountability from the NPCI. NPCI is a private company; it's a private non-profit company, and so it is not accountable under RTI. But I think as a critical payment infrastructure, we need more transparency and accountability. The Reserve Bank of India also needs to provide sufficient disclosure about the functioning of the NPCI, which the Reserve Bank of India does not do today.
To address failed payment concerns, fintech unicorn Razorpay recently launched refunds for failed UPI transactions on its point of sale devices that would reduce the time taken to provide refunds to just 2 minutes against the industry standard of 5 to 6 business days. Fintech's post CEO Vyas Nambisan said that the move would help merchants offer a more seamless payment experience to their customers, as they normally lose their business in 30 to 40% of the cases where the customers are unwilling to make a double payment via UPI in case of a failed transaction. According to Nambisan, 5 to 15% of UPI transactions see friction due to pending status. UPI transactions hit a new high in value in January by touching 18.4 trillion rupees. UPI transactions were 52% higher in volume and 42% higher in value last month as compared to January 2023. Evidently, the stakes are too high. So what else can be done apart from improving the digital infrastructure?
One market way of addressing this problem is to allow for competition against NPCI so that it sort of fixes their game.
Experts agree India's digital payment infrastructure, on the whole, needs improvement to handle the fast-growing volumes of digital payments in the country. They also point out that the Indian market does need more transparency, accountability, and competition for NPCI going forward.
UPI, meanwhile, is going places. After France, this payment system was launched in Sri Lanka and Mauritius on Monday. Let us now move on to financial markets. India Inc.'s Q3 earnings season is close to a wrap with key surprises from high-stake sectors like IT and financials. Our next report by Harshita Singh lays out on a granular analysis of earnings in the December quarter and what the underlying trend means for the coming months.
India Inc.'s December quarter earnings largely met expectations, with highest incremental gains being led by domestic cyclicals and capital-intensive sectors as per analysts. Industrials, auto, metal, cement, and oil and gas fueled earnings growth in Q3, while those in the consumption universe like retail and chemicals lagged the most. Within financials, which hold nearly 33% weightage on the benchmark Nifty 50, private banks saw weaker than expected earnings on account of lagging deposits, lower NIMs, and higher provisions due to RBI's tightening of AIF investments, noted Motilal Oswal Financial Services. On the index level, 33 Nifty companies reported an aggregate year-on-year profit growth of 21% as of February 1, marginally ahead of the 20% growth estimated by the brokerage. On a granular scale, the highest contributor to Nifty profits were Reliance, HDFC Bank, TCS, ONGC, ICICI Bank, and SBI. However, Indian Oil, JSW Steel, Tata Motors, Adani Enterprises, and Tata Steel saw the sharpest profit growth between 130% to 1700%. UPL, Tech Mahindra, and Britannia, on the other hand, reported steepest declines in their bottom line. Besides, IT earnings, which managed to top expectations despite seasonality and furloughs, was a key surprise, said experts.
The surprise was the IT sector results and especially the commentary of the management. That reflected in the share prices of big wigs like Infosys, TCS, and HCL Tech. It seems that it is bottoming out of their underperformance and the next rally of Nifty might be led by them.
As for the outlook for coming quarters, analysts at ICICI Securities count rising cost pressures ahead due to the Red Sea crisis, an uptick in commodity prices, and rural stress from possible weather anomalies as key near-term challenges for India Inc. earnings. Likely delay in rate cuts after the recent RBI policy also add to these worries.
If we talk about underperformers, it was seen in chemical sector, consumption theme, and FMCG. If we talk about key concerns, then that is obviously inflation, and that is weighing on India Inc. performance. Recent commentary of the RBI regarding withdrawal of accommodation because of liquidity was not received well by the markets. The process of rate cuts might get delayed due to such issues. A shortfall of monsoon may also result in supply side issues and may affect consumption across India.
Thus, the brewing Red Sea crisis and geopolitical worries might keep export facing sectors under pressure for some more time, even as the street bets on IT turnaround from the new fiscal. Today, on 13th February, investors will react to retail inflation data from January and IIP output for December.
He's making plans for an early retirement. Business Standard.
Thanks to buoyancy in IT, oil and gas stocks, key benchmark indices had touched a new height recently. Speaking of oil, Indian Strategic Petroleum Reserves Limited or ISPRL has inked a pact with Hindustan Petroleum Corporation to lease 300,000 metric tons of storage space for 3 years in a strategic petroleum reserve in Vizag. But what is a strategic petroleum reserve? Ayush Mishra explains.
Product prices hinge on the dynamics of supply and demand in today's world, which is more connected than ever before. It applies to oil too. Disturbances in one region can send strong ripples across the globe. Like in 1973, when oil-producing nations in the Middle East tightened the oil supply in response to the United States' support to Israel during the Yom Kippur War, the prices of oil shot through the roof. It came to be known as the energy crisis or oil shock of 1973-1974. So to hedge against such sudden oil crunch, countries started maintaining oil reserves. In the event of a significant disruption, whether caused by politics or natural calamities, nations with reserves can mitigate price spikes by releasing a portion of their reserves. Strategic petroleum reserves are stockpiles of crude oil maintained by nations to guarantee a reliable crude oil supply in the face of geopolitical uncertainties or disruptions in the oil supply chain. These underground storage sites are crucial in sustaining a consistent provision of energy sources. Under the International Energy Program Agreement, all member nations of the International Energy Agency must uphold emergency oil reserves equivalent to at least 90 days of their net oil imports. In 2017, India became an associate member in the International Energy Agency. Its Strategic Petroleum Reserve is maintained by Indian Strategic Petroleum Reserve Limited. It is a wholly owned subsidiary of the Oil Industry Development Board under the Ministry of Petroleum and Natural Gas. India has limited oil storage capacity with space for only 39 million barrels of crude. It is barely enough for 8 days of the country's consumption. And the government had released a third of that to local refiners in 2021. So the current strength may be close to 26 million barrels. In contrast, the United States' current capacity was 346.8 million barrels as of July 2023. A Reuters report recently claimed that India's finance ministry has scrapped a 50 billion rupee plan to recharge the country's strategic crude oil reserves. Market volatility and the prospect of a further decline in prices is said to have led to this decision. The crude oil storages are constructed in underground rock caverns and located on the eastern and western coasts. Crude oil from these caverns can be supplied to oil refineries either through pipelines or via a combination of pipelines and coastal movement. Underground rock caverns are considered the safest means of storing hydrocarbons.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
India keeps its strategic oil stockpiles at 3 sites. They are Visakhapatnam, Bengaluru, and Padur. It is building 2 other commercial strategic reserves at Chandikol in Odisha. Well, that is all for today. For more news, views, and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.